is not your data being used against you. It's your data being used, aggregated with everybody else, and being used against other people. So if you're in Christchurch, you did not need to be on YouTube or on Facebook Live to be dead. You just needed to be in the mosque. Same thing at the Walmart in El Paso, and same thing in Myanmar. And to my mind, now we're coming into the territory where this data is a lot like things like plutonium, or like cloning human babies. There's certain things that from a societal point of view, you just don't let people do, even if they want to. You don't let people use heroin, right? I mean, and I'm sitting there going, I think Mark Benioff is absolutely right when he talks about the narcotic effect of these business models. Yeah. And again, we just have to have a conversation. I'm not saying I'm right. I'm asking people to imagine, join me in a thought experiment. What if I'm right? What would you want to do differently? Because on current course and speed, we can't have these platforms encourage candidates who lie. They encourage really socially dysfunctional behavior and across a really wide range of activities. And I'm just sitting there going, hang on. This is America. We can do better.
One last theory is that maybe they're being so laissez-faire on this stuff because they're thinking about payments for the next 5 to 10 years. Yeah. And that's where their focus is. Do you think that's fair?
Yeah, you know, Zuckerberg pointed out, and he points out over and over again, political ads are a small percentage of our business. This is actually de minimis for us. We're doing it because we think it's the right thing to do. I think the big answer for Facebook is they want to be a generational company. They want to last a long time. They want to be big. All of these problems are because of their size. And they're saying, well, there are two options. Either we let Elizabeth Warren break us up if she wins, or we accept onerous regulations such that our competitors don't exist. I think they're aiming towards that regulatory scheme.
Guys, big questions. It's a good way to start the hour, though. Thank you very much.
My pleasure.
Roger and Eli.
And when we come back, Netflix shares are falling, getting a downgrade over at Macquarie. The analyst behind that call and a former Netflix exec are going to debate where the stock goes from here. That is next. Stay with us.
How do we make the future of energy ours? By knowing who we are, where we're going, by remembering the roads we've traveled, while developing new paths of our own. At American Electric Power, we're working to generate new ideas and empower possibilities for us all. Shaped by who we are, where we live, and what we value, the future is ours to hold.
Why do so many homeowners start home repair and improvement projects at HomeAdvisor?
With HomeAdvisor, we know we're going to find the right pros for absolutely any project.
You can read reviews,
compare prices,
and book an appointment online.
And it's free.
Go to HomeAdvisor.com.
Consistency delivers. Time and time again. Columbia Threadneedle Investments.
5G is a very high-speed connectivity technology. Think about IoT applications or autonomous vehicle applications. The ability to connect in mining operations, smart cities, smart traffic systems are going to really come to life. And you don't have to go dig and bury cables. Think about what this technology can do for the delivery of healthcare alone. I believe that 5G is going to be one technology that actually lives up to the hype. This is the...
Searching for a more memorable short break? Fly from London Heathrow to Cork from $55.99 each way as part of a return trip with Aer Lingus. Step off the plane and into a warm welcome in Cork. Surround yourself with breathtaking coastal views. Soak up the culture of Cork City or head to the colourful town of Kinsale and indulge in the best seafood around. Smart Ireland. Smart flies, Aer Lingus. Book now at aerlingus.com. Offer subject to conditions and availability.
The world's longest wedding dress was longer than the Grand National Racecourse. Think that's big? Tonight, the Euro Millions jackpot is a colossal £32 million. 32 million! Now that's big.
Euro Millions from the National Lottery. Amazing starts here.
Estimated jackpot rules and procedures apply. Players must be 16 or over.
Welcome back to Squawk Alley. Netflix getting downgraded over at Macquarie, citing price concerns versus its other streaming peers amid increased competition. Stock's down about 5% right now after popping yesterday on the heels of earnings. Joining us now is the analyst behind that call, Tim Nolan of Macquarie, as well as Netflix's former director of content acquisition, Simon Gallagher. Good morning to you both. Tim, I'll start with you. Why the downgrade? Give us the details.
Well, it's quite simple, actually. U.S. Subscriber growth has reached a nice high level here. I think that pace of growth is slowing. I think given last quarter's miss and this quarter's miss in the U.S. and a lower number for Q4 expected than we had previously had, caused us to look at our numbers going out. I thought they were a bit too high given the coming competition. Lowered our U.S. subscriber growth forecast. That led to a lower implied valuation, and so we just took off the outperform rating.
Simon, should Netflix, and I say this based on some of the comments we got from Reed Hastings after earnings 2 days ago, should Netflix be more concerned about competition?
I don't think so. I think there's been a tremendous overreaction about the coming competition. I think people should be more focused on the churn-off pay TV services. And if they were really going to dive into the details, I think they need to look at the content lineup on Disney+, on Apple. You're talking about 619 titles launching on Disney Plus versus the 6,000 plus titles that we have on Netflix here in the US. So I really don't think that Disney's going to be a fantastic service, but the volume is not there, and I don't think the threat is quite as strong as everyone thinks.
Simon, this seems to me to be about data versus inspiration and creativity. Disney has a machine for creating content that people seem to like, but Netflix has this global platform and rich data, and the question is that data going to let them make smarter bets about what to make and whom to show it to? You work for a couple different streamers. How big a difference does that data make?
I think it makes a big difference, and you see that in the earnings jump yesterday, popped 40% above what was projected. I think that Ted and Reed and the team over at Netflix are very well aware, and they're learning every day about what content they do and don't need, and their ability to bring down that content spend is only improving over time. So there's a tremendous amount of room. They're currently paying 0.001 cent for each title that's on the service. Disney, by comparison, 0.01%, so about 10 times as much per individual title. Netflix can definitely scale back the volume of content on the service, and they learn every day about what they need in each individual territory. And so their ability to bring down those costs is only improving over time.
Yeah, just to dig into that a little bit more, Tim, I mean, if you have the U.S. market maturing here, and I know you mentioned in your note that you suspect pricing power is limited, and yet content costs continue to climb, how sustainable is that? Is there a tipping point, whether it's Netflix or some of its other coming competitors, is there a tipping point in terms of the prices that are going to be paid for that content?
I just think with competing services coming on at lower price points, and they will be attractive services, it just makes it harder for Netflix to raise price over time. They still have a couple quarters ahead of the price increases from earlier this year rolling through. I think they can still get some ARPU increase just from people signing up at higher tiers. And we still have Netflix subs growing, actually, for the next 2, 3, 4 years. The question is, just though, with so many streaming services coming on, Disney Plus and Apple Plus, immediately in the next few weeks, I just think consumers will have a plethora of options for different streaming services, and they will jump around. I mean, Netflix set this standard where you can sign on and sign off with 1 or 2 clicks. It's so easy. I assume the others will be the same, and that means consumers, I think, will simply jump on and off and on and off and on and off services. I don't think Netflix permanently loses subscribers to Disney. I think they might lose some for a period of time while people go to Disney Plus, for example, and then they'll come back to Netflix and watch, the next episode of their favorite show. So I just think it's going to be a matter of increased churn, by which I mean on and off and on and off. The competition means pricing for content will continue to rise and demand for content will continue to rise. I think it will also mean marketing costs will have to remain high, as Netflix will be sending out messages and so forth to try to get you to stay on or come back on. So
that's interesting.
The cost is high.
If it does become as easy as just changing the channel, then, I mean, what is it? What's going to be an acceptable number on churn? And are subs going to be even relevant as a metric in 2 or 3 years?
I don't know what the right churn number is, but again, I'm thinking of churn in terms of churning on and off and on and off and on and off. And that overall will probably limit the ability of Netflix to simply keep adding subscribers. I just think these are a lot of attractive services that will have a lot of interest to a lot of people.
So Simon, how should we be looking at the value of Netflix? Is it just in terms of how much they're spending on content and then how many people they get to look at it? Or do we have to look at this as a global membership platform where eventually, even if it's not advertising, they start selling something else?
You bring up a good point. They're currently speaking to 160 million plus consumers around the world. Jim Cramer last night on Mad Money talked about their ability to speak to international consumers is better than anyone. So certainly that presents an opportunity, but I think it's not something that's probably on their roadmap immediately. I'm sure they consider it, they think about it, but I don't think that's anything that's on their roadmap at the moment. They're just all about being laser focused about delivering the best streaming service. They're not trying to sell phones, they're not trying to do the best shipping, they're just about building the best global streaming service. And I think at the moment they're succeeding very well at that.
I agree with that. I think the international opportunity is great.
Got it. Lastly, Simon, I just got to get your thoughts on these big bets on films. So you've got Apple opening its first film in theaters this weekend, The Elephant Queen. Obviously a big bet happening at Netflix on feature films as well. What is the value proposition of that type of content versus, say, TV series where it seems very sticky to me? What do films bring to the table?
Look, films bring high profile. They're great from a marketing standpoint, but they don't engage the consumer for the same duration as a TV series does. But again, they create a big splash. They create a halo around the platform, and they get people to engage. Sure, they might only engage with the film for 90 minutes, but then it's given you a jumping off point to go and discover other content on the service. And also, the service gets data on what you like to watch. And off the back of that film, maybe there's an associated TV series or something that they might be able to drive you to.
All right, gentlemen, thanks for joining us today. Tim and Simon.
Meantime, speaking of movies, today will mark a big first for Apple, releasing a movie in theaters ahead of it being available on Apple's own streaming service in a few weeks. So what does that mean for the likes of Amazon and Netflix, who have their own big screen strategies? Or Julia Borston has more on the streamers' battle for theaters. Julia.
Well, John, movie theaters are the new battleground for these streaming giants to compete both for subscribers as well as for top content creators, because you need to put movies on the big screen in order to qualify for awards such as the Oscars and Golden Globes. Now, Apple's nature documentary Elephant Queen opens today in 10 cities around the U.S. and U.K. before it's included in Apple TV Plus's November 1st launch. The film drawing rave reviews, which Apple is sure to highlight in its promotion of its new service. Now, this is one of 3 Apple releases this fall. It'll be followed by indie feature film Hala in November and then crime drama The Banker in December, while Amazon is releasing 5 films and Netflix is releasing 10 films. That's its most ever in this key fall season. Now, perhaps the most high profile of these films is Netflix's The Irishman from Martin Scorsese. On November 1st, happens to be the same day as Apple TV Plus launches, Netflix will offer this drama in independent theaters before it streams on Netflix at the end of that month. Now, none of these films will stream the same day they launch in theaters. Netflix's theatrical windows are less than a month, so none of the big theater chains, which demand a 3-month window, will run those Netflix films. Apple is also doing limited releases, while Amazon is the outlier with 3 traditional theatrical releases of 3 months, which gets it access to the big theater chains. In addition to this fall is doing 2 releases with short 2-week runs. Now, this fall, these streamers are chasing both awards and critical attention to promote their services to potential subscribers and also to draw top talent. The thing about talent is they not only want to qualify to win awards, but they also want to make sure that with the crush of all this content, that their work isn't lost in all of these shows on all of these streaming services. There's so much out there right now, guys. Back over to you.
It's true, Julia. You got to get paid, but you got to get seen. That's part of the game. Julia Borston with the unbelievable changes in media in the last few years. We're nearing the close of the week for the European markets. The biggest movers of today's trade are coming up next as Dow's down 66. Don't go away.
You still have service? Call the insurance company.
It's them calling us.
It's going to be a week before they can get through on these roads.
Sorry, I didn't catch that.
I said ask how soon they can be here.
Right now.
What's now?
He says they're surveying our property now.
Probably at the wrong house.
I don't see any hovering.
His name's Hovering?
Look up.
By automating claims with machine learning and analytics, Cognizant is helping insurance companies advance how they serve even hard-to-reach customers.
Cool.
Markets, the business of trading goods and services. NASDAQ operates among the largest markets in the world, and our technology powers markets from Indonesia to Chile. Great markets are built on a foundation of trust and integrity, forged through leading-edge technology and a smart regulatory framework. As technology advances, regulation must keep pace to allow the markets to evolve. Today, we see an opportunity to modernize regulation, to make markets more accessible to investors and entrepreneurs of all sizes. From the graduate buying her first stock to an institution investing in thousands, the markets belong to everyone and stand as a symbol of economic advancement, social progress, and limitless opportunity. That's the tomorrow that we envision. And to get there, we'll have to rewrite it today.
For drug-free sinus and allergy relief, experience Navage.
This time of year, I get so stuffed up, but Navage flushes my sinuses so I can breathe again.
Navage uses powered suction to flush out allergens, germs, mucus, and dirt.
My doctor recommends Navage to breathe better through my nose, and it works. Congestion's gone, and I feel great.
And Navage is so much easier than a neti pot.
Trusted by happy noses everywhere, Navage is nature's decongestant. Online and at these fine retailers.
Ted, going on a trip, huh? Taking an off-road station wagon, eh?
You know it's an SUV.
Your family is ducking and rolling while we stowing and going. But that's cool. I know for a fact your SUV does not suck.
And why is that?
It ain't got that vacuum in the back, sucking stuff up. What else are we gonna find?
We gotta go.
Vacuum in the back. Hallelujah.
Get 0% financing for 60 months plus $2,250 total bonus cash on the 2019 Chrysler Pacifica.
CNBC's Capital Exchange, where business and politics converge. December 4th in Washington, D.C., creating opportunity in America's heartland. Register now at cnbcevents.com. Brought to you by Prudential.
Sunday night, Carson Wentz and the Eagles face Dak Prescott and the Cowboys. Predict what will happen with the new free-to-play game Sunday Night 7 on NBC Sports Predictor. With $2 million in cash prizes this season, $100,000 guaranteed each contest.
European market set to close in just a moment on what's been kind of a rough day. Seema Modi is here at the exchange for the breakdown of the action. Seema.
Hi, John. And let's start with a snapshot of global markets on the heels of that lackluster China GDP report. You can see a negative session in Asia, pulling European stocks down with it. And notable weakness in European auto stocks with that China exposure. We had French car maker Renault. Shares are down nearly 12% after it cut its sales and profit guidance for 2019. The company citing tough market conditions and economic backdrop that is less favorable. Some of its key competitors like Peugeot and Fiat Chrysler, you can see they're under pressure as well. And a similar story for those auto suppliers like Michelin and tire maker Pirelli. Keep in mind, Renault's challenges are certainly not isolated. This is a wider problem for the larger industry, which has come under pressure in large part due to that sharp decline in demand from China. So that's certainly one sector to keep an eye on. Finally, we are counting down to tomorrow's Parliament vote in the UK, where Prime Minister Boris Johnson is fighting to secure approval of the deal that was backed by the EU tomorrow. We've seen a run-up in a number of these Brexit-related names, specifically the UK banking stocks like Royal Bank of Scotland, up 10%, guys, just this week. But the question is whether that story could change if those votes are not secured tomorrow. Guys, back to you.
Seema, thank you. It's time now for a news update, and Sue Herrera has that back at HQ for us. Sue.
I do indeed, Morgan. Thanks so much. Here's what's happening at this hour, everyone. Secretary of State Mike Pompeo traveling to Israel from Turkey, meeting with Israeli Prime Minister Netanyahu in Jerusalem to reaffirm the two countries' close ties.
We had a chance to talk this morning about all the challenges that the world faces and that Israel and the United States face head-on together as an important beacon of hope and democracy here in the Middle East. The American people value this relationship.
Energy Secretary Rick Perry announcing his resignation. Speaking on CNBC earlier today, he says he wants to return to the state he loves, and that would be Texas. Perry says that he will leave his post by the end of the year. He has served as Energy Secretary since the Trump presidency began. And California firefighters battling a wildfire burning in Santa Barbara County. The fire, which broke out Thursday afternoon near El Capitan Canyon, has burned some 443 acres. Authorities say it's about 20% contained. It closed nearby Highway 101 for a short period of time. Santa Ana winds out there whipping up those flames. That is the news update this hour. Back downtown to you guys. Morgan?
I hope they can contain it fast.
Yes.
So, thank you. Getting a check on where we stand across the major averages. It's red arrows as the Dow's down 73 points. The S&P is down 4. Communication services and tech stocks leading the losses. Keep in mind, though, the Dow and the S&P are still on pace for a second straight week of gains. We're back after this break.
Sure, a resume is a great way to see someone's experience, but you're not hiring a resume, you're hiring a person. That's why Indeed offers tools that help bridge the gap between a candidate and their resume. Like skill tests, which let you actually see a candidate's abilities in action to make sure they're a good fit for the job. It's no wonder Indeed delivers 3 times more hires than any other job site. See beyond the resume with Indeed. Post your next job at Indeed.com/skills and try skill tests for free.
Picture those perfect days of your youth. There was a time to live your youth. Now may be the time to invest for your retirement. Get our free bond guide to get started. You've worked hard all these years with retirement in mind. Isn't it time to invest in something that gives you investment income that's federally tax-free? Since 1990, Henyon & Walsh has specialized in investment-grade tax-free municipal bonds. Our free guide explains the benefits and risks of municipal bonds, how they provide federally tax-free income, facts every investor should know, as well as strategies for smart bond investing. They say nothing in life is free. Thankfully, that doesn't apply to our bond guide. Call 800-376-4376 to find out what tax-free can do for you. If you have $10,000 or more to invest, get your free bond guide right now. Call 800-376-4376. That's 800-376.
1 in 10 Londoners surveyed said they'll give more to charity in the next 12 months. Are you one of them? At CAF, we help generous people like you support their favourite charities by making giving simple. And we provide charities with the tools they need to perform at their best. So together, we can make a bigger difference for our communities. We're a charity and a champion for better giving. We are CAF, and we make giving count. Visit cafonline.org to find out more.
They don't chant your name when you give blood or sing songs about you. But patients and their families will remember you forever. Because your blood can change their lives. We need more blood donors in Tooting, the West End and Edgware. Bleed for London. Join us today at blood.co.uk.
10-year yields coming in on these comments from Clarida. Let's get to Steve Leisman. Steve?
Yeah, Carl, thanks very much. Richard Clarida, the Vice Chairman of the Federal Reserve, who is one of the leading monetary policy experts on the committee, saying policy is not on a preset course. The committee is deciding what to do with rates, quote, meeting by meeting, echoing language that the chairman used last week. He said the Fed will act as appropriate to sustain growth. Another note, he says the Fed's bill purchases, which are growing its balance sheet, should not be considered to be quantitative easing. Overall, though, he says the economy is in a good place. The outlook is favorable, but he does note the following risks. U.S. economy confronts global growth weakening, disinflationary pressures, fixed investment from businesses declining, and manufacturing is weak. 2 other speakers today, Robert Kaplan, the Dallas Fed president, saying it, quote, may be wise to take more time before deciding whether to cut again. And Esther George, the Kansas City Fed president, saying the economy does not require rate cuts. Carl, the issue here, I think, is whether or not to take Clarida at face value, meaning he really is neutral, or the market tends to think of this as, you know what, he's not leaning against where the market is priced, therefore we should go ahead and expect that rate cut. So it's an interesting question as to whether or not Clarida means to guide us this way or that way, but In the actual language he's using, he is very neutral about what the Fed's going to do at the end of this month.
Yeah, and then Kaplan used the word agnostic. I mean, are you having doubts about October, Steve?
I think it's more in play than I believe the market is priced for. Last I checked, it was an 83-85% probability of a rate cut. There's a bunch of stuff between now and then. There's durable goods. There's the ECB is going to meet. Interestingly, Carl, the problem for the Fed is a lot of the stuff that it would really want to make that decision happens either on the day of, where you get ADP and GDP that day, or a day after, which is the jobs report, or 2 days after the jobs report, or in the most important case of all, the Xi-Trump meeting, or the potential meeting on trade, is 2 weeks after. And I don't think anything right now is more consequential for what the Fed does than what happens on the trade issue.
All right, Steve Leisman, thank you.
Pleasure.
Meantime, Elizabeth Warren's proposed wealth tax creating some interesting potential challenges for CEOs and founders whose wealth is tied to their stock price. Robert Frank joins us here at Post 9 to explain. Robert.
Hey, John. Well, one of the issues with a Sanders or a Warren wealth tax is how to value a person's wealth that is tied to a volatile stock. Now, Netflix CEO Reed Hastings, for instance, would have paid wealth taxes of about $120 million back in July when he was worth about $4 billion. Today, he would pay about $30 million less in wealth taxes because of what happened in Netflix stock. Now, Warren's advisors on her plan said that a wealth tax would be calculated based on a person's net worth at the end of the year, so presumably that day would be December 31st. Now, accountants and tax lawyers say that could lead company founders and CEOs to talk down their stock price toward the end of the year, run up to that date, and then talk it back up, or at least would allow it to bounce back up in January once they pay their tax bill. You also got the issue of stocks possibly suffering in December because executives and founders would need to sell that stock, and in some cases millions of shares, just to pay the tax. So let's look at Jeff Bezos. He would owe more than $3 billion in wealth taxes under Warren's plan and $8 billion under Sanders' plan, so he would have to sell millions of shares. Now, the other problem with taxing wealth tied to stocks, of course, is that you'd get big swings in tax revenues. Harold Hamm, for instance, of Continental Resources, he was worth $19 billion last October. Now he's worth less than half that, but as consolation, he would pay $300 million less in wealth taxes because the stock has gone down so much. So look, in the list of issues with a wealth tax, this is probably kind of minor, but it just points to how volatile wealth is today because they're tied to stocks that can swing wildly within a month, let alone within a year.
Have you ever seen a proposal like this before? Like, have you ever seen anything similar to this implemented before? And if so, what were the consequences?
Well, the most similar thing we have is the estate tax, where the government has to come in and say, okay, this person just died. What is the value of their entire estate? Now, what they do with the wealth tax, rather than pin it to that one day, they give you kind of the option to give you a 6-month period. And there are all kinds of games that accountants and lawyers play to get the lowest valuation possible within that 6-month period. So we would have that times 10.
All right, Robert, hang out with us here for a bit. All of this ties into the growing conversation about capitalism, whether or not it is in crisis. Salesforce chairman and co-CEO Mark Benioff joined us earlier this week with his own thoughts on the subject. Take a listen.
Capitalism is dead. We need a new capitalism. We need a new sustainable, fair, more equitable capitalism. We need a capitalism that values not just shareholders, and of course, I love shareholders, but as important, stakeholders. A capitalism values stakeholders. Who are your stakeholders? Your customers, your employees, your partners. We have many stakeholders, not just shareholders.
Let's bring in noted tech investor Bradley Tusk. Bradley, thanks for being with us.
Sure.
So is capitalism dead?
No. Look, I think what you're seeing both from Benioff, from Warren, from Andrew Yang with his universal basic income are the introduction of concepts that have their supporters, have some merits to it, but the time between when that idea gets floated out there by a politician or a CEO and it becomes public policy and law, I think we're looking at a period of years at least.
Are we talking about really economic stratification and lack of mobility? It's arguably harder to move from one economic rung to another. Is that what's at the core of this, do you think? And what's the solution?
Yeah, I mean, look, people are frustrated, and people at both sides of the equation have figured that out. If you look at now the two front runners. It's Donald Trump and Elizabeth Warren. They're both populists in their own way, but in many ways they're saying similar things, right? Which is the system is screwing you over, and I'm going to protect you. And I'm going to get vengeance for you. They obviously disagree on a lot, but that's really appealing. That frustration is not going away anytime soon. So I think where a guy like Benioff is insightful is he recognizes that if you just keep the status quo going indefinitely, the guillotines are going to show up sooner or later. So you've got to change course at some point. But the distinction between Warren saying, I'll make Jeff Bezos pay $8 billion a year, and the reality of it is still pretty significant.
So then is a wealth tax an unrealistic way to try and, I guess, sort of level the playing field for economic inequality?
It depends what you're trying to solve for, right? If you're trying to say, I just want some people to have less money, then a wealth tax would do a good job of taking money away. If you say, I want a wealth tax to fund universal health care, universal college, whatever it is, you can create a government program, you can fund it. Whether it actually is then effective is another story. And the reality is government's neither as bad as the Republicans say it is, nor as good as the Democrats say it is. There are some programs like Medicare that work pretty well, but if you look at the average graduation rate for community colleges, it's below 20%. So, just putting more money into something that doesn't solve it, and just keeping money in the private sector doesn't solve it either.
Do you think it would dampen innovation and lessen the incentives for entrepreneurs like Bezos, like Jeff Gates? I mean, Warren has said, look, Jeff Bezos would have started Amazon even if we had a wealth tax. Yeah. Do you think that's true?
I mean, while I'm reluctant to agree with Elizabeth Warren, I do think she's right, because ultimately Jeff Bezos did this because he wants to create, he wants to change something, he wants to take down the status quo.
So that innovation machine in America, you don't think would be effective?
I'm not really. Like, I invest in early stage startups, and these founders that we're investing in have a big idea, and they're trying to change an entire industry, and they're not really thinking about what a 2% wealth tax would impact them post an IPO or an acquisition.
But they do have aspirations to get wealthy.
For sure. But how would they get wealthy by not innovating?
I agree. I'm just saying that the incentive is eroded at the margin.
Maybe.
I'm not going to be as wealthy.
I think that, or where it is at a certain point, you question, like, for example, my company is based here in New York City. We pay really high taxes. I pay 100% of all of my employees' benefits. There is a point where I say to myself, do I want to keep hiring people, keep growing this thing if the incremental profit keeps going down?
This is my question to you, because we've seen state migration is a statement by some wealthy people right now.
Yeah, and that is different from saying I'm just going to stop working. I mean, the Warren's advisors figured that the optimal tax rate for the wealthy before they decide, look, it's not worth working anymore, is 75%. So we've got a long way to go between 37 and 75%, which is the point at which most economists determine the wealthy just say, look, it's not worth it. It's not worth innovating. It's not worth working. I'm moving to Florida and retiring.
Robert, at what point do you think we can say that the culture, the political culture, has really shifted, changed? Because, I was listening to that Democratic debate. Very little talk about small business, about entrepreneurs, about aspiring to create and employ. It was about these people have the money and we're going to get it from them. It seemed different.
I've been thinking a lot about that, John. And remember when Warren said in the debate that basically, I don't have a beef with billionaires, but we built the roads, we made the schools, we fund all the things that got you there. Well, that was word for word what Obama said and got scorched for it. She said it and no one paid attention. And I think the extent to which the crisis has changed people's fundamental view of the wealthy has continued into today. And I think the electorate is very populist now. The fact that Warren is where she is a reflection of that. And I think this election is going to be as much about wealth and the wealthy as it is about all these other policies. It's changed. America has changed.
Yeah, and we're watching it play out. Robert, Bradley, thanks.
Thank you, Robert.
Keep your eye on Snapchat today. Slightly lower. Did get an upgrade over at B of A to a buy. They see some acceleration in ARPU. They expect positive EBITDA for the first time this quarter. We'll watch that. Dow's down 83.
Hi, my name is Sam Davis, and I'm going to tell you about exciting plans available to anyone with Medicare. Many plans provide broad coverage and still may save you money on monthly premiums and prescription drugs. With Original Medicare, you're covered for hospital stays and doctor office visits, but you have to meet a deductible for each, and then you're still responsible for 20% of the cost. Next, let's look at a Medicare supplement plan. As you can see, they cover the same things as Original Medicare, and they also cover your Medicare deductibles and coinsurance, but they often have higher monthly premiums and no prescription drug coverage. Now, Let's take a look at Humana's Medicare Advantage plans. With a Humana Medicare plan, hospital stays, doctor office visits, and Medicare deductibles are covered. And of course, most Humana Medicare Advantage plans include prescription drug coverage. In fact, in 2018, Humana Medicare Advantage prescription drug plan members saved an estimated $7,400 on average on their prescription costs. Most Humana Medicare Advantage plans help you stay active and keep fit by including a Silver Sneakers fitness program at no extra cost. And you may be able to save on dental and vision expenses because coverage is now included with most Humana Medicare Advantage plans. You get all this coverage for as low as a $0 monthly plan premium in many areas. And your doctor and hospital may already be a part of Humana's large network. If you want the facts, call right now for the free decision guide from Humana. There is no obligation, so call the number on your screen right now to see if your doctor is in our network, to find out if you could save on your prescriptions, and to get our free decision guide. Licensed Humana sales agents are standing by, so call now.
I created Hint Water to make water taste better. We started in one grocery store. Now we're online and everywhere. And we couldn't have done it without NetSuite. NetSuite's cloud-based software gives me visibility and control of all my business systems. Budgeting, forecasting, supply chain, everything I need to keep growing. NetSuite makes running my business simple, so I can focus on what I love and what's next.
Schedule your free product tour right now at netsuite.com/grow.
I'm Scott Wapner. Here's a look at what's coming up halftime before top of the hour today. Tom Lee joins us with a new call, a bunch of stocks that he says you should buy right now. So we're going to debate that list. Plus, our call of the day is one firm's best idea in the entire market. And we're going to break it down with our investment committee. We'll also get you ahead of next week's most important earnings. A lot is on the docket next week. McDonald's, Amazon, many more. We'll do all that when we see it noon. Guys, we'll see you in about 15.
All right, Scott, thanks. We are watching J&J close to session lows here, down about 4 1/3% after announcing it's recalling some of its baby powder, finding some traces of asbestos. There's a conference call going on right now. Some of the headlines are that they received a report from the FDA on the contamination of its talc on October 17th. Reviewing manufacturing records on where the product was distributed. They plan to do some lab testing on the retained samples of that baby powder. But Kramer highlighted, obviously, what's potentially litigation risk on this name, despite what the print was about some other healthcare companies this month.
Yeah.
Yes, indeed. Yeah.
It's the biggest drag on the Dow, too, which is down 94 points now.
Meantime, let's get to the CME, get the Santelli Exchange. Morning again, Rick.
Good morning, Carl. You know, breaking to the markets, Claret, of course, Fed comments did push rates down a basis point, basically tens from 174 down to 173. They're virtually unchanged on the day, down a smidge on the week, but not a lot of movement this week in Europe. More movement. You know, with regard to the Fed, here we are, at least challenging, especially in the Dow contract highs, all-time highs. The other indices not far behind. And today we learned, of course, that China's GDP at 6.2, basically the lowest since record keeping in the early 90s, may sound like a better number, but anybody who's traded options and understands delta, the rate of change is definitely not working in China's behest with regard to future outlook. Should our Fed ease? They've done 2. Should they do 3? It's a tough call just based on the markets. I don't think it's a very tough call based on markets, economy, and all the other issues that should be involved, especially watching European rates have an aggressive bounce. They were at minus 71 at the end of August. They traded intraday as high as minus 33 yesterday, hovering just on the north side of minus 40 basis points, a big improvement. But we never really think about China outside the politics regarding the trade war. If there was no political timeline, you know, maybe many Americans and more politicians would be a little tougher. I don't know all the ultimate details of stage 1, but let's go to the boards. You know, if you look at the Shanghai Composite, the stock market in China, and you look at it on a monthly basis and you go back 20 years, here's a chart of their stock market, roughly at 29.40 right now with all-time highs in 07 to 59.54. It's basically half. You go to the U.S. Dow Jones Industrial Average. It doesn't look nearly like that chart. Maybe what's more interesting is this is kind of the trade war era. You can see how their markets acted. Look at how our market's acted. Now, you could argue we've been doing a lot of sideways for a year and a half, but sideways up here is a lot better than sideways down there, no matter how you slice it. And let's slice off this chart and look at GDP year over year in China. We saw it was 6.2. This goes back to 05. Here's China's GDP. Here's our GDP. We see the crisis era times here. We're roughly at 2.4 on our last look. The new GDP we're looking at for the third quarter is most likely going to be somewhere around the 1.8. At least that's the current read. Which would you rather have? Which stock market would you rather have? Which side of the negotiating table would you rather be on? Morgan, back to you.
Some key charts there, Rick. Thank you. After the break, the rise of ghost kitchens, what they are, and why everyone is using them. And no, it has nothing to do with Halloween. That's next. We're back in a minute.
For thousands of years, owning gold has been not just a symbol of wealth, but also one of the best commodities to invest in. Now, with the help of Monex, a trusted name in precious metals investments for over 50 years, you can add gold bullion to your portfolio. Call us now to speak with one of our knowledgeable account representatives and ask how you could receive free gold and a free investor kit. You heard correctly. For a limited time, each new customer who acquires at least 20 ounces of any gold coins will receive a free 1/10 ounce gold American Eagle coin. Free gold could be yours after just one purchase. And if you call right now, you'll receive a free investor kit just for calling. In this kit, you'll learn about the ease of investing in gold and the benefits it could provide to your portfolio. Don't wait. Call Monex and add the power of gold to your portfolio.
Lots of chatter out there about the sleepers, surprises, and the favorites.
Well, there's a time for talk, and there's that time we call show me time.
That time is now.
The biggest companies in the world are set to report.
And nobody breaks down the numbers like we do.
Who's up?
Who's down?
Who outperformed predictions
and met expectations.
We don't just deliver the what.
We explain the why.
It's about performance.
And opportunity.
It's a Friday afternoon happy. Listening to a banger happy. There's no traffic on the M1 happy. England won the Ashes happy. There's only 68 days until Christmas happy. It's almost home time happy. Getting 10% off your new Michelin tyres along with a free coffee happy. You get that kind of happy from QuickFit in Watford. Book online now at quickfit.com and drive away happy. Terms and conditions apply.
And to say happy birthday, we're giving you a pair of award-winning Silver Galaxy Buds.
But it's not my birthday till June.
No, but it's ours. 10 years ago, we launched our first Galaxy smartphone. And to celebrate, we're giving customers who purchase any Galaxy S10, Note 10 or A90 5G the chance to claim a pair of amazing wireless Galaxy Buds.
Wow, and I didn't get you anything.
Get the latest Samsung Galaxy smartphone now at your local EE shop or ee.co.uk. Offer available on purchases made by the 23rd of October 2019 and claimed online within 30 days. T&C supply.
Welcome back to Squawk Alley. The latest trend in the restaurant world, ghost and virtual kitchens. Kate Rogers is here at Post 9. She's going to explain what they are, why companies like Alphabet, Uber, and more are getting into the space.
Americans spent $10 billion on food delivery services last year, and restaurants large and small are looking to cash in by using extra kitchen capacity to service delivery. These virtual kitchens are run out of existing restaurant kitchens. There are also ghost kitchens, which are standalone centers. Both serve the growing online delivery category. Los Angeles-based Fatburger franchise locations have become virtual kitchens for Florida-based Hurricane Grill and Wings, introducing a new concept to the LA community sold strictly on third-party delivery apps. Franchisees are seeing a boost in sales.
A virtual restaurant enables the franchisee to sell more product under a different brand and have incremental profit and make more money. So they're making an extra $2,000 to $5,000 a week in incremental sales.
Data from Morningstar finds ghost and virtual kitchens can utilize anywhere between 10 and 50% of the square footage, require 15 to 50% of labor depending on program structuring, and generate 75% to 100% of the transactions of a traditional restaurant operating in the same category. Uber Eats has 4,000 virtual restaurants globally, which it says are boosting companies' sales. Uber Eats handles the tech components on its app.
The virtual restaurant brings 35% incremental sales relative to what the parent brick and mortar business does on Uber Eats.
Now, these concepts are known by many different names: kitchen centers, cloud kitchens, dark kitchens, and more. They may vary in their form, but all focus on one thing, and that is growing delivery business. In fact, Wendy's said at its Investor Day last week that it'll have 2 dark kitchens open before the end of the year to help it grow in areas that offer big delivery opportunities or in areas that may not have worked previously due to real estate constraints, which is interesting because Wendy's is kind of the first big fast food player now we've heard saying it's going to push into this space.
This is absolutely interesting. I'm wondering what happens if and when we see an economic downturn. Does this become even more lucrative, or is this something that goes away?
So a lot of people think that obviously fast food will be one of the last places we'll see consumers cut back because it is so cheap, but delivery of fast food can be expensive because there are all of these added fees. So analysts say while these concepts may be really smart right now, if we do hit a recession, that's one area that consumers could pull back because you do have to pay an extra $4, $6 or whatever it may be to get that food delivered.
You mentioned the real estate, which is a very big deal, but also like kitchen